What we often don't think about is that for the return and the risk portion of this, we have to specify a periodicity. Are we going to specify these things with a monthly, a daily, an annual time period? Now, humans are kind of naturally wired to think about the year. It's the time it takes the Earth to do a lap. We do things on an annual basis, so it's natural for us to think about things on an annual horizon. And if the data we have isn't annual, we'll often extrapolate, we'll annualize to get there. And there's nothing wrong with that. I mean, at the end of the day, any period we pick is going to be arbitrary. There's nothing really wrong with a year, but we need to think about what are the implications of that choice. And we often blithely do this extrapolation without really thinking that through. What we're implicitly assuming is that returns are independently distributed, so that returns each period are not related to returns from the last period. In fact, in many cases, that is not true. And as a result, the extrapolated estimate of what risk would look like in an annual horizon can diverge from what it actually looks like on the annual horizon because of that lack of independence. Let me give you a few different perspectives on this. Many of us, whether we invest in momentum strategies or not, we at the very minimum may think of momentum as a factor. We could debate if it's a factor or not, but the very existence of momentum as a strategy is an implicit belief that there is some autocorrelation in returns. Momentum is telling us that returns from previous periods are relevant to the current period. So if you believe momentum exists in some context or some points in time, then you're implicitly acknowledging that there's some autocorrelation. This sort of phenomenon that I've just illustrated for you can happen. There are some behavioral issues at play here too. So my colleague, David Turkington, has a paper, I can't recall if it's out yet or coming out in the FAJ, where he looks at a new factor that he and the team have discovered that relates to currencies. And the factor is looking at the local equity market return in the prior period. So it turns out there's a correlation between prior period local equity returns. So think of return of equities in Japan. For last year, can have information regarding the performance of the yen next year. And it seems like there's some dynamics in terms of the way investors behave and rebalance that can make this the case, but certainly statistically it's there. So that's one example of kind of a lagged cross-correlation between two assets. Some asset classes, just by their very nature, the way they're built, have some autocorrelation. So think about bonds. Bonds pay a relatively consistent coupon in most cases, right? Which naturally introduces a component of autocorrelation into their returns, which you'll observe in many instances if you look at their total returns. Private markets, by their very nature, the way that private markets are priced, private markets transact rarely, if ever. And when they do, we don't usually know those prices. So private markets, to come up with their estimates of risk and valuation, we rely on appraisals, which are inherently anchored to prior period appraisals and comparative companies. So the returns for infrastructure, private equity, private debt, these series are notoriously autocorrelated. And as a result, their risk over longer horizons is much, much greater than you'd anticipate by extrapolating their risk over shorter horizons. We haven't discovered anything here that nobody understood. There's no new math. It's really just highlighting a common assumption that we all make that's hard-coded that we should take a fresh look at and just think a little bit more carefully about. So it's an easy remedy. We just need to look at the autocorrelation and potentially the lagged cross-correlations. So if we're investing and we're devising assumptions for our asset classes, do we see evidence that there's significant autocorrelation in their returns? If there is, this issue may be at play. An easy way to do that, by the way, is also just do the monthly correlation and volatility, and then annualize that or try annualize that, and then look at the actual look at overlapping 3-year periods and see if they're different. And if you see big differences, then there's evidence historically that there was some divergence. And then you have to decide, why was this? And do I think this will persist? And is it something I should build in a forward-looking way? If it doesn't, and it doesn't exist everywhere, I mean, in many cases, the square root of 12 rule kind of works very nicely. So if it doesn't exist, then you have less to worry about. We want to have the relevant history, which forces us to go, get less and less data. We want to have statistically useful data, which forces us to go further back. And that is an inherent trade-off. And I don't have a magic solution to that. I think it's a trade-off where we just have to use good judgment. I will also point out, some of my colleagues, Dave Turkington, Mark Kritzman, Megan Souzonis, have a paper coming out they introduce a technique called partial sample regression. And I mentioned earlier this regression tool they're using to predict presidential elections, and they're using that tool, partial sample regression. And the idea is to identify historical periods that are relevant to today. So, where has the data behaved like it's behaving today? And what they find is that, and I'm simplifying it, there's more to it, but if you give those periods more weight in your forecast, you can get a better forecast. And they show that in a number, they forecast factors, presidential elections, a number of different things. So I think there are also ways to try to identify the parts of history that may be most relevant to today. This assumption, that the requirement to annualize volatility using the square root of 12 is hard-coded into the GIPS. So if you're a manager, an investment manager, and you want to report your Sharpe ratio in a way that's compliant with the GIPS, you are required to use monthly returns and annualize them with the square root of 12. And by the way, not a knock on the CFA Institute. I am a proud CFA charter holder, and it's a fantastic organization, and we're big fans of the Financial Analyst Journal. But I know they're also an organization that values debate and transparency. And this is something I think should be a topic of discussion.